We are diving deep into the foundation of the American economy today, the housing market.
Yep, and we're looking at one of the biggest players, Lennar, which just dropped its Q4 and full year 2025 results.
And they used a phrase that I think really sums it up. They called the current environment stubbornly difficult.
It's the perfect description. But, our mission today is to look past those immediate numbers, past the margin pressure. We want to understand the long game.
Right. We need to figure out why. Why is Lennar intentionally, it seems, sacrificing profit right now to just push pure volume?
Exactly. And how they're transforming themselves into what they call a hyper-efficient manufacturing company. It's really a playbook for surviving this affordability crisis.
And maybe even for thriving later. We've got some incredible metrics to dig into that show this shift.
Oh yeah, like the near total sell-off of their own land, a massive asset-light move.
And a 10% reduction in construction costs over 2 years of inflation. That's kind of incredible.
And the cost of it all, a hefty 14% in sales incentives during the quarter.
Okay, let's get into it. Let's start with the environment that, as you said, forced their hand.
So let's set the stage. Lennar, even though they hit their volume goals, they were very clear about how tough the market is.
The underlying story hasn't changed, right?
Not at all. Demand is strong. Demographics, household formation, that's all there. But the supply of housing, especially affordable housing, it's desperately short.
And the economic environment in Q4 wasn't exactly helping things. Lennar noted that even though interest rates slowly moderated through the fall,
September, October, November.
the consumer response was, and this is their word, tepid. People were just still on the sidelines.
Well, and that hesitation was amplified, right? You have to remember the political side of things. There was the threat of a government shutdown, which then actually happened.
Right, from October 1st through mid-November.
And Lennar pointed to that directly. They said it further eroded already weak consumer confidence. You just can't expect people to make the biggest purchase of their lives when the government is literally closed.
It all feeds into this core problem they're trying to navigate. And it's more than just interest rates, isn't it? It's the affordability crisis. It's structural.
It is. Their leadership called it being entrenched in an affordability crisis. And they said it's leaving a lot of average American families, quote, excluded from the traditional promise of upward mobility and home ownership.
And this really matters to you, whether you're trying to buy a home or you already own one.
That's right. Because Lennar is operating inside what they call the supply paradox. We all know there's a housing shortage. Mayors, governors, Republican, Democrat, they all say it's a crisis.
So the simple solution is just build more houses, right?
Well, that's the paradox. The builder points out that just flooding the market to drive down prices is incredibly risky.
Risky for existing homeowners. Tell us a bit more about that balancing act.
Exactly. The risk is that if you crash home values, you hurt the, 85 million Americans who already own homes.
That's a massive group of voters.
A massive voting bloc. And if you diminish the value of their primary asset, you could trigger a much deeper financial crisis. So policymakers are kind of stuck.
That's critical context. So this isn't just a construction problem, it's a political one. So where does Lennar see a path forward?
They believe housing is going to become a central element in policy debates. And crucially, they noted that federal officials have already started discussions with them.
To understand the problem better.
To understand it, and this is a really telling phrase, to avoid unintended negative consequences. That suggests they're being very cautious.
Which means a government move to boost affordability in 2026 is what, likely?
I'd say it's pretty probable, maybe through subsidies or some kind of financing help.
So while they're waiting for that help to arrive, Lennar is taking control. Let's shift to the Q4 numbers and see how that volume strategy actually played out.
They delivered 23,034 homes. That's up 4% from last year.
And new orders?
Even stronger. Up 18% year over year. Almost 20,018 homes. So they're definitely not pulling back.
No. They grew their community count to over 1,700, an 18% jump, and kept a sales pace of 4.0 homes per community. But the margin is where you really see the cost of that strategy.
That's where the rubber meets the road. Q4 gross margin came in at 17.0%.
Oof. Down from what, 22.1% the year before?
Exactly. A noticeable decline. And it's from lower revenue per square foot and, believe it or not, higher land costs year over year.
And the main tool they used to keep those homes moving was incentive.
Huge incentives, about 14% on average. That's everything from rate buydowns to help with closing costs.
All to avoid, as they put it, an unintended buildup of excess inventory. The average sales price on those homes was about $386,000.
And that 14% number is everything. It defines their entire leverage to the upside opportunity. Think about it for a second. In a normal market, incentives are what, 4 to 6%?
Right, so they're basically compressing a spring right now, paying for future profit today.
That's a perfect way to put it. That 8 to 10% gap between today's 14% and a normal 4-6%. That is pure margin opportunity just waiting. The moment the market turns, they can ease off that lever and all those efficiency gains drop straight to the bottom line.
Before we dig into those efficiency gains, we should probably touch on the Millrose divestiture. A little bit of financial housekeeping they did.
Right. They completed the split off their last 20% stake in Millrose. It was really the final step in their exit from non-core businesses.
Streamlining their focus.
Purely on high-volume, hyper-efficient home building. That's it.
The technical result was a one-time paper loss, about $156 million, but it also triggered a cashless repurchase of $8 million of their own shares.
Which is part of a big year for shareholder returns. For all of fiscal 2025, they returned about $3.2 billion to shareholders. So they were aggressive on all fronts.
Which brings us to the pivot itself, this transformation into a manufacturing company. This is where that Q4 margin pain starts to make a lot of sense.
It's all about making the product cheaper and faster to build. And look at the results. They cut their vertical construction costs by about 10% from 2023 to 2025.
10%? In an inflationary period, that's just remarkable.
It is. And direct construction costs were also down 2% just from last quarter and over 5% from last year.
And they're building them faster. Their cycle time foundation to completion is down to 127 calendar days.
Just 127 days. That's an 8% reduction year over year.
Let's pause on that. 127 days. I get that it's a competitive advantage, but what does that speed mean for the buyer? Are they just getting a cookie-cutter home with no options?
The sources suggest no, because the speed is structural. It's about process. For Lennar, faster builds mean they tie up less capital for less time.
Fewer inventory carrying costs, less interest.
All of it. It just makes their whole capital engine run faster and more efficiently.
And that efficiency is what unlocks the next huge strategic shift, the asset-light land model. This might be the most profound change of all.
It's a radical transformation. Their own land on the balance sheet is now less than 5% of their total inventory.
Less than 5%. For a national home builder, that's just staggering.
It directly de-risks their balance sheet. Their owned home site supply went from 1.1 years worth down to just 0.1 years.
How do they even do that?
Through controlled land. They use land bank relationships for just-in-time delivery of lots. That's now 98% of their supply, up from 82% last year.
So they're basically renting land instead of earning it. It avoids all those carrying costs. But doesn't that introduce a different kind of risk? What if their land bank partners get into trouble?
That's the calculated risk, yes. But their scale is their protection. They are the biggest buyer, so they have immense negotiating power. For them, it means almost zero capital is tied up in unproductive land just sitting there. They've essentially outsourced the riskiest part of the business.
And none of this would be possible without a serious investment in technology, which is not something you always associate with home building.
Precisely. On the sales side, they're tracking metrics that sound more like a tech startup. They're obsessed with RFI requests for information response times.
And what are those times now?
The average response time in Q4 dropped to 42 seconds.
42 seconds.
42 seconds. That's a 12.5% improvement. And they have digital agents available 234/7.
That's faster than most online retailers. It makes them competitive in a whole new way.
And on the production side, it's the same story. They have a national bidding software tool that streamlines managing thousands and thousands of SKUs in real time. That software is what allows them to make fast, centralized decisions that lead to those cost cuts we talked about.
This whole manufacturing focus, backed by tech, is really changing their structure, which brings us to the management shift they announced.
A huge one. The co-CEO and president, John Jaffa, who they called their plow horse, is retiring after more than 40 years.
And the really telling part is how they're handling his replacement.
Right. They're not hiring one.
No replacement.
Nope. The duties are just being absorbed by other tenured leaders already there. Jim Parker and David Groen on operations, Greg McGuff on strategic functions.
So they're actively cutting costs at the highest levels of the company. It's amazing to think that technology has basically made a role that existed for 4 decades redundant.
They said it themselves. The decision is directly tied to tech. Their operational structure is becoming shallower because the efficiency gains allow for more delegation and require less high-level oversight. They built a better machine, so it needs fewer hands on the wheel.
That really is the path forward. Let's look at their 2026 guidance. Q1 is expected to be the low point.
Yeah, the seasonal low. They're guiding for 17,000 to 18,000 deliveries and a gross margin somewhere in the 15 to 16% range.
But the full-year outlook is still aggressive. They're projecting about 85,000 home deliveries for all of 2026.
Which is about 3% growth over 2025's final number of roughly 82,500, so still pushing volume.
The final synthesis of their strategy, then, is pretty clear.
They're committed to volume to drive those internal efficiencies. And they're going to wait patiently for the market to normalize so they can dial back those incentives.
And when that happens, all those structural gains, the 10% cost cuts, the faster cycle times, the asset-light model, all that flows straight to the bottom line.
Exactly. It's a classic case of taking a short-term margin hit for a massive long-term efficiency gain.
So this has been a deep dive into a company that is really fundamentally restructuring itself in the middle of a tough market.
The key insight is that this isn't a temporary fix. They call it structural, not episodic. By leaning into this now, they've positioned themselves to be incredibly levered to the upside the moment things ease up.
Whether that's from lower rates or some kind of government action, we saw the numbers, the 10% cost reduction, the 127-day cycle time.
The 38% improvement in inventory turn. But I agree, the most compelling metric might be that internal one. The decision not to replace a top executive because the technology has made the organization that much more efficient.
Which leaves us with a final provocative thought for you to consider. If a giant home builder like Lennar can leverage technology, from bidding software to AI customer service, to actually remove high-level management layers and speed up everything from land deals to sales.
Well, the question is, what's the timeline for this Lennar machine approach to fundamentally redefine the human capital structure for the whole home building industry, which has traditionally been so slow to change?
They're not just automating construction, they're automating the C-suite itself. That's definitely something for you to mull over as we watch the housing market head into 2026.